Have you ever driven on a newly paved road? One that's so smooth it feels like you're almost flying, and maybe wondered about the whole network of businesses that actually made that happen?
Hmm.
Or maybe considered what really goes into building all that vital infrastructure, the stuff that connects our cities and states, the arteries of our economy, basically.
Yeah, this is a massive undertaking.
Well, today we're going to take a deep dive into a company that's right at the heart of this kind of work, especially actually in one of the fastest growing regions of the U.S.
Okay.
We're going to unpack Construction Partners, Inc. They trade on NASDAQ under the ticker ROAD, ROAD.
Aptly named.
Very aptly named. You could think of it as, well, a pure play investment in the very literal roads that are shaping America's future. But, it isn't just a story about asphalt and gravel.
No, there's a lot more strategy involved.
Exactly. It's about a really strategic business model,
Yeah.
one that's capitalizing on, well, massive federal spending, these rapid demographic shifts we're seeing, and a pretty clever approach to what's traditionally been a very fragmented industry.
Right.
So, our goal for this deep dive is basically to cut through all the complexity, give you the critical insights into this really fascinating company and its place in the bigger infrastructure picture.
Mm.
We'll explore its unique operational model, the powerful tailwinds pushing its growth forward, the risks it has to navigate, and it does navigate them, and what all this means for you, whether you're just observing economic trends or maybe you're just curious about how our physical world actually gets built.
Sounds good.
And to do that, we've pulled together quite a stack of materials. We've got a comprehensive investment analysis, the company's own filings, the 10Ks, 10Qs, earnings, transcripts, industry reports, macro data, pretty much the works, yeah. Together, they paint a really detailed picture of road. So, let's get started. Okay, so Construction Partners, Inc., or ROAD, they are quite literally building the backbone of America's infrastructure. When we talk about their core business, what are we really looking at?
Well, at its heart, it's a vertically integrated civil infrastructure company. Their main focus, like the ticker suggests, is the construction and maintenance of roadways. That's the bread and butter.
Right.
But, their scope goes a bit wider than just roads. They also handle bridges, airport runways and taxiways, and broader site development services, too. Stuff like installing critical utility and drainage systems for big projects.
So heavy civil construction.
Exactly. It's heavy civil, capital-intensive, very hands-on work. It requires a lot of expertise, a lot of specialized equipment.
You mentioned vertically integrated right at the top there. Now, for a lot of people, that's kind of a business buzzword. What does it actually mean on the ground for a company like Road? And maybe more importantly, why is it such a big deal in this industry?
Yeah, that's a great question because vertical integration is really fundamental to understanding road. What it means for them is that they control almost every single step of their value chain.
Okay, the whole process.
Pretty much the whole thing. It's not just paving the roads, they're deeply involved in actually producing the materials that go into those roads. The absolute cornerstone of their operation is making and distributing hot mix asphalt, or HMA.
HMA, got it.
They operate this really dense network. I think it's up to 84 HMA plants now across their territories. And these plants aren't just applying their own internal paving crews. They use it themselves, yes, but they also sell that HMA to third-party contractors.
Ah, okay. So it's an internal supply source and an external revenue stream.
Exactly. Creates efficiency and another way to make money. But it goes even deeper than that. They also mine their own essential raw materials.
Like the rocks and sand.
Precisely. The aggregates. Yep. Road owns and operates 17 of its own facilities where they extract sand, gravel, crushed stone. These are the primary inputs for making that HMA.
So they control the supply right from the source.
Right, which gives them a huge advantage in terms of both cost predictability and, crucially, supply assurance. They're not just relying on someone else.
Makes sense.
And to really button it up, they even operate 3 liquid asphalt terminals. Liquid asphalt cement is another critical ingredient for HMA production. They want to make sure they have that secured too.
Wow. Okay.
And then finally, of course, they provide the actual paving and construction services themselves, applying all these materials they've manufactured or sourced directly in their projects. So yeah, it's way more than just laying down asphalt. It's controlling the whole process from quarry to road.
So it sounds less like just doing the construction work and more about meticulously controlling the ingredients and the logistics of that work. But why go to all this effort? What's the real strategic edge here? Why is controlling every step so important?
Well, this vertical integration, it isn't just some operational quirk. It's really the central pillar of Road's competitive strategy. It effectively builds what you could call a strong economic moat around their business.
Okay, a moat. How does that work in practice?
Think about it in a few ways. First, it gives them incredible cost control. By owning the production of aggregates and the asphalt itself, they insulate themselves, to a large degree, from the price swings you see in the open market for these key inputs. Other contractors are subject to that volatility. Road, less so.
So more predictable costs, better margins potentially?
Exactly. Which leads to the second point, margin capture. If they were just buying aggregates and asphalt from a third-party supplier, that supplier would be making a profit, right?
Yep.
By producing it themselves, Road gets to capture that material supply margin. It enhances their overall profitability directly.
Okay, that's clear.
Third, it ensures supply assurance and quality. They have a reliable, timely source of high-quality materials right when they need them. In construction, delays are incredibly costly. Avoiding material shortages or quality issues is absolutely crucial for meeting project deadlines and keeping clients happy.
And avoiding penalties, I imagine?
Oh, absolutely. And then, maybe the biggest piece, is that it creates a really substantial barrier to entry for potential competitors.
How so?
Maintaining this kind of physical asset base, 84 asphalt plants, 17 aggregate facilities, those liquid asphalt terminals that represents an immense capital investment. It's not cheap to build or maintain that infrastructure.
Right.
And particularly in local markets, think about the materials themselves, aggregates, asphalt. They're heavy, they're bulky. Transporting them long distances is just not economical. The weight-to-value ratio is too high.
So you need local sources.
You absolutely need local sources. Roads, dense, localized network of plants and quarries makes it incredibly difficult for a new player to come in and compete effectively on cost and logistics within those specific areas. It sort of boxes out rivals before they can even get started.
So this integration really turns what seems like a commodity business, asphalt rocks, into a strategic fortress. It's a fascinating example of how operational strategy can build a really strong competitive edge, even in a field that might look boring from the outside.
That's exactly it. It's fundamentally strategic.
Okay, so they've got this powerful internal engine, this integrated model. Where are they actually putting it to work? Because their geographic focus, the Sunbelt strategy, seems just as important as the business model itself. They operate exclusively in places like Alabama, Florida, Georgia, North Carolina, South Carolina, Tennessee, Oklahoma, and now Texas. That's not just random, is it?
No, not at all. That geographic focus is a highly deliberate strategic choice. It's designed specifically to capitalize on what are arguably the best macroeconomic and demographic trends in the entire country right now.
I think the Sunbelt boom.
Exactly.
Yeah.
The Sunbelt region is experiencing this, what you could call it a virtuous cycle. You've got strong population growth, robust job creation, corporations relocating.
Right.
And all of that directly translates into massive demand for new and improved infrastructure, roads, bridges, site development, everything road does.
And the numbers back that up.
Oh, dramatically. Projections suggest the Sunbelt will grow its population at something like 22 times the rate of non-Sunbelt regions over the next decade. That's staggering.
22 times.
Yeah. And just look at last year, 2023, Texas and Florida led the entire nation in attracting new residents. So this isn't just a forecast, it's happening right now. It's a region experiencing explosive, sustained growth, and road is positioned right in the middle of it.
Okay, that sounds like an incredibly smart place to be. But if we connect this back to the bigger picture, focusing so heavily on one geographic region, even a booming one, doesn't that also concentrate risk?
It absolutely does. That's the other side of the coin. While they stand to benefit tremendously from the Sunbelt's growth, they're also more vulnerable to things specific to that region.
Like what?
Well, regional economic downturns, for one. If the Sunbelt economy were to slow significantly, they'd feel it more acutely than a more geographically diversified company. State-specific political or budgetary shifts are another factor. Changes in state funding priorities could impact them heavily. And then there are climate-related events. The Southeast is prone to hurricanes, tropical storms, periods of heavy rainfall.
Right, things that stop construction work.
Exactly. In fact, their Q3 fiscal 25 report specifically called out record or near-record rainfall across many of their markets as causing significant project delays in that quarter.
So it's a real tangible risk.
It is. So the strategic challenge for them becomes, how do you effectively balance capitalizing on this incredible high-growth opportunity with managing the inherent risks that come from such a concentrated geographic exposure. It's a strategic tightrope they have to walk.
I see the trade-off there. Concentrated opportunity versus concentrated risk. So they're strategically located in the Sunbelt. Who exactly are they building all these roads and things for? Let's dig into their customer mix, public versus private.
Their public projects are, by a significant margin, their dominant source of revenue. In Q3 of fiscal 25, something like 64.9%, almost two-thirds of their consolidated revenues, came from publicly funded work.
Okay, so government contracts mainly.
Right. Federal, state, and local governments. Contracts for highways, roads, bridges, airports. This segment has historically been a very stable and, frankly, predictable source of demand, especially given the long-term nature of infrastructure planning and funding.
And within that public bucket, any key customers?
Absolutely. State departments of transportation, the DOTs, are critical. In fiscal year 2024, all the state DOTs they work with collectively accounted for just over 40.7% of their total revenues.
Wow, that's significant.
It is. And the Florida DOT alone represented 13.6% of their revenue that year.
That sounds like some customer concentration risk, though, doesn't it? Relying so heavily on a few state agencies.
It is a concentration risk, and they acknowledge that. But they're actively working to mitigate it, primarily through geographic expansion. Their big move into Texas, for example, is expected to quickly make the Texas Department of Transportation, TXDOT, one of their top 5 customers.
Ah, so spreading the reliance across more large state programs.
Precisely. Diversifying within that large public customer base, even if the overall customer class remains governmental. It spreads the risk across multiple major, well-funded state programs.
Okay, so that's the nearly two-thirds public side. What about the other third?
The remaining 35.1% of their revenue comes from the private sector. This involves things like paving and site work for commercial and residential developers, building roads and infrastructure for industrial parks, that sort of thing.
So capitalizing on the private development boom that comes with all that population growth.
Exactly. This private sector work provides valuable diversification away from pure government funding cycles, and it allows them to directly capitalize on the robust private development activity that naturally accompanies the Sunbelt's significant population and economic growth. It's a nice complement to the public work.
Okay, so it definitely sounds like they're well positioned, both operationally and geographically. Now let's zoom out a bit. What's the broader economic environment telling us about the demand for their services? Are they catching a big macro wave right now?
Oh, they absolutely are. You could argue they're operating within one of the most favorable macroeconomic backdrops for the U.S. infrastructure industry in, well, generations.
Yeah.
It really is a generational opportunity playing out.
Okay, what's driving that?
Let's start with the big one, federal funding. The Infrastructure Investment and Jobs Act, the IIJA, which was signed back in November 2021. This thing is genuinely transformative.
The trillion-dollar bill.
That's the one. $1.2 trillion in total authorized spending. But the key number is the approximately $560 billion in new funding spread over about 8 years.
Okay, new money.
New money. And crucially for a company like Construction Partners, about 52% more than half of those new funds are specifically directed towards roadway and broader transportation spending.
Right, in their wheelhouse.
Directly in their sweet spot. What this does is create this multi-year, highly visible pipeline of projects. It significantly de-risks the demand outlook for contractors focused on public works like road. They know the funding is there, committed for years to come.
Can we see that impact directly in the states where road operates?
Yes, very clearly. The IIJA funding flows down to the states through various formulas. So, for example, Alabama is projected to get around $5.8 billion, specifically for highways and bridges over 5 years. That's a big jump, about a 32.3% increase over previous federal funding levels.
Wow.
North Carolina, they're said to receive $7.2 billion for roads and bridges, which translates to about a 29% annual increase.
Yeah.
And Texas, where road just made that huge Lone Star paving acquisition.
Yeah.
Texas actually receives the single highest allocation of any state from the IIJA. That provides even more fuel for their already massive state transportation program. So this consistent influx of federal money directly empowers the state DOT's roads key customers to undertake larger and more numerous projects. It gives everyone a strong sense of long-term demand certainty.
That's a massive tailwind from the federal level, but you hear a lot about how state and local governments actually fund most infrastructure. Are they stepping up too, or just relying on the federal money?
That is a critical point. While the IIJA grabs the headlines, state and local governments remain the dominant force. They accounted for something like 79% of all public infrastructure spending in 2023.
Okay, so the lion's share still.
Absolutely. And what's really impressive, especially in roads footprint, is that many of these key states aren't just passively receiving federal funds. They are actively amplifying them with their own substantial funding initiatives. They're putting their own skin in the game, big time.
Can you give some examples?
Sure. Take Florida. Their recent state budget included a historic $15.6 billion specifically for transportation infrastructure. Within that, $5.4 billion was earmarked just for highway construction. That's huge state-level commitment.
Okay.
South Carolina has this ambitious 10-year plan for infrastructure. That plan has nearly quintupled their active construction program to a record $4.8 billion.
Quintupled. Wow.
Yeah. And North Carolina's legislature recently approved a measure to dedicate a portion of the state's sales tax revenue specifically to transportation. That's projected to provide an additional $9.7 billion in highway funds through fiscal 2033.
So these states are really doubling down on infrastructure investment.
They are. You see strong, often bipartisan state-level commitment across the Sunbelt to invest heavily in modernizing infrastructure. It provides this crucial secondary layer of demand security, underpinning the federal boost.
And it all seems to tie back, again, to the Sunbelt demographics we talked about. That economic and demographic boom just keeps adding fuel to this fire, right?
Precisely. Road's exclusive focus on the Sunbelt positions them perfectly to benefit directly from these incredibly powerful trends. We mentioned the projection, the Sunbelt growing its population 22 times faster than non-Sunbelt regions.
Yeah, that number is sticking with me.
It's hard to ignore. And states like Texas and Florida leading the nation in new residents in 2023. That's real, tangible growth happening now.
And that translates directly to construction.
Directly. More people, more businesses mean more cars, more need for goods movement, which means more need for roads, bridges, everything. The 2024 construction outlook for the whole southern region showed a net positive expectation of 37%, specifically for bridge and highway projects. And states like Georgia and North Carolina, both key road markets, were ranked #1 and #5 in the country for overall construction strength.
So, pulling it together for the listener, what does this all mean?
It means this company, Construction Partners, is operating in this uniquely favorable environment. Demand for what they do isn't just stable, it's actively surging. And that surge is driven by both deliberate public policy, the massive infrastructure spending, and these powerful underlying demographic shifts in the fastest growing part of the country. They're literally building out the physical infrastructure needed for America's growth engine.
That is a truly compelling picture on the demand side, a real confluence of positive forces. But, every silver lining usually has a cloud somewhere, right? And let's flip the coin. What about the industry headwinds? It can't all be smooth sailing, even with all this money and demand.
You're absolutely right. Despite the incredibly positive demand outlook, the construction industry as a whole faces some significant operational challenges. And road is right in the thick of it.
Okay, like what? What are the main headwinds?
Probably the biggest, most persistent one is the scarcity of skilled labor. It's a critical issue across the board.
We hear about that a lot.
And the data confirms it. A 2024 survey by the Associated General Contractors, focusing just on the South region where road operates, found that a staggering 79% of construction firms reported difficulty filling positions.
Wow, nearly 80%.
Yeah. And 58% cited labor availability as one of their top concerns for the year. Now think about the INGA. All that new funding is expected to create hundreds of thousands of new construction jobs. Which sounds great, but
It's going to make the shortage even worse.
it's likely to exacerbate the existing shortage, yes. Which really raises a crucial question for road. With its aggressive growth plans and rapidly expanding project load, how do they actually attract and retain the skilled workers they need to execute all this work effectively in such a tight market?
It sounds like a real scramble.
It is. You hear stories about companies getting really creative with hiring bonuses, covering training costs, trying everything to find and keep good people. It's a major operational constraint.
Okay, so labor is number one. What else?
Another significant headwind is material costs and potential supply chain volatility. Now, things have definitely improved since the peak disruptions during the pandemic, but material cost inflation is still a risk.
For things like asphalt, steel.
Exactly. Liquid asphalt, cement, steel, aggregates, diesel fuel, the core inputs. That same AGC survey I mentioned found that 61% of Southern contractors cited rising material costs as a top concern.
And all this high demand doesn't help prices.
Probably not. Sustained high demand, especially from these big federally funded projects, which are often less sensitive to price increases, could keep costs for these key inputs elevated. That puts pressure on margins, especially for contractors who bid fixed-price contracts.
Right, you lock in a price and then your costs go up.
Precisely. It squeezes your profit. And then finally, there's the impact of rising interest rates. This is particularly a concern for the private development side of roads business.
The non-government work.
Right. Higher financing costs for developers. The people building housing complexes or commercial centers can make their projects less viable. It might lead them to postpone projects, scale them back, or even cancel them outright.
Is that showing up as a concern?
Yes. 62% of Southern contractors in that survey listed rising interest rates as a top concern. It directly impacts the flow of private projects that rely on affordable capital. So road has to navigate that potential slowdown on the private side, even while the public side is booming.
Okay, so they're facing these very real operational challenges, labor, materials, interest rates, despite this fantastic macro environment and their strong business model. How does Construction Partners actually achieve its growth goals in this kind of complex environment? It sounds like acquisitions aren't just part of their strategy, they're pretty much the main engine, right?
Yeah. You've hit the nail on the head. Acquisitions are absolutely their primary growth lever. The company's main growth driver is its role as a strategic consolidator in what is still, despite some big players, a highly fragmented civil construction industry. There are lots of smaller local companies out there.
And Road is buying them up.
Methodically, yes. They have this very deliberate platform model for M&A. What that means is, when they enter a new state or a major new metropolitan area, they typically start by acquiring a large, well-respected local company. That first big acquisition serves as the platform.
A base of operations.
Exactly, a base. Then, from that platform, they make subsequent, usually smaller, bolt-on acquisitions in that same region.
Okay, why the smaller ones?
Those bolt-ons are crucial for increasing their market density, more crews, more plants in that area. They also use them to deepen their vertical integration locally, maybe buying an aggregate quarry or another asphalt plant nearby. And sometimes they add new service lines that the platform company didn't offer. It's about building dominance within that specific region after establishing the initial beachhead.
Have we seen examples of this recently, these platforms?
Oh, absolutely. We've seen several really transformational acquisitions just recently that perfectly illustrate this strategy. The most notable one has to be Lone Star Paving in Texas.
That was a big one. I remember hearing about it.
Huge. This single deal gave Road an immediate, at-scale presence right in the heart of booming Central Texas. Think Austin, San Antonio, the Temple-Killeen corridor.
And it wasn't just the company name, right? They got assets.
A ton of assets. The deal included 10 hot mix asphalt plants, 4 aggregate facilities, and a liquid asphalt terminal. Just boom, instant vertically integrated Texas operation.
Wow. And the financial impact.
Massive. It was projected to add something like $530 million in annualized revenue and $120 million in adjusted EBITDA starting in fiscal 2025. Management actually said this deal alone accelerated their long-term margin targets by 2 years.
Incredible. Any others like that?
They also entered the Tennessee market by acquiring PRI, establishing another new platform there. And then just recently, in August 2025, they did another Texas deal, acquiring Durwood Green Construction, further expanding their footprint in that critical state.
So the reliance on M&A for growth looks really clear from those examples.
It's undeniable when you look at the numbers. The financial impact is stark. In Q3 of fiscal 25, acquisitions contributed a massive 46 percentage points to the company's overall 51% year-over-year revenue growth.
Wait, 46 out of 51% growth came from acquisitions.
Exactly. Which means organic growth from their existing operations accounted for just 5% in that quarter.
That's striking.
It is. And it was similar. In Q2, acquisitions drove 47% of their 54% revenue growth. These figures just clearly underscore how much they currently rely on M&A for that high growth trajectory everyone sees.
So what makes them successful at this? Why do companies sell to Road?
Well, what's really fascinating here is the reputation they seem to have built in the market. Management has apparently cultivated this strong reputation for being a fair and reliable partner to the companies they acquire.
How so?
They tend to retain the existing local management teams, which is huge for continuity and morale. They also often preserve the operational autonomy of the acquired company, letting them keep doing what they do best, just with more resources.
So not just coming in and completely changing everything.
Right. And that approach seems to create this kind of proprietary pipeline of acquisition opportunities. You hear that founders of these often family-owned businesses frequently prefer selling to an industry operator like Road, someone who understands the business, respects the legacy, rather than selling to a purely financial buyer like a private equity firm who might have a different playbook focused on cost-cutting or quick flips.
It makes a lot of sense. It's like choosing a custodian for your life's work.
Exactly. It's a key intangible asset for them in this M&A game.
So they're not just buying revenue streams, they're buying local expertise, maintaining goodwill, ensuring continuity. And these acquisitions, do they also tie back to strengthening that vertical integration we talked about earlier?
They do, very much by design. Acquisitions aren't just about getting bigger geographically. They're strategically used to deepen their vertical integration in each market.
Got an example?
Sure. Back in 2021, they acquired Good Hope Contracting in Alabama. A key part of that deal was that it added 4 aggregate facilities to their Alabama network. Another deal they did in North Carolina was specifically executed to secure an aggregate source, a quarry, for some existing asphalt plants they already owned in that region.
So filling in the gaps in the local supply chain.
Precisely. It's about continuously reinforcing that supply chain control in each new market they enter or expand in. It strengthens their competitive moat, ensures material supply, helps control costs locally.
Okay, acquisitions are clearly the dominant growth engine right now, but what about organic growth? Growth from the businesses they already own, especially these newly acquired platforms, and how does their project backlog fit into this whole picture?
Yeah, that's the next logical question. While M&A grabs the headlines with those huge growth numbers, management's philosophy, as they state it, is that today's acquisitions drive tomorrow's organic growth.
Meaning?
The idea is that these newly acquired platform companies, once they're part of Road, can leverage Road's larger scale, its resources, its vertical integration advantages, maybe its bonding capacity, to actually gain market share and grow organically within their local markets over time, faster than they could have on their own.
Okay, so the acquired companies are expected to start growing faster post-acquisition. Are they guiding for that?
They are. For fiscal 2025, the company guided for a pretty healthy 8% to 10% organic revenue growth rate, which, for this industry, growing your existing business by almost double digits organically is quite strong.
Definitely. And the backlog, how does that play in?
The project backlog is probably the most tangible indicator we have of their future revenue stream. It's a really powerful metric. The backlog represents the total value of all the contracted work they have signed up but haven't completed yet.
So work that's already locked in.
Locked in, yes. And it has been growing at a remarkable pace. At the end of Q3 fiscal 25, it hit a record $2.94 billion.
Wow, nearly $3 billion in future work lined up.
Exactly. And what that means is it provides a very high degree of revenue visibility for the near term. Management estimates that backlog covers somewhere between 80% to 85% of their expected revenue for the next 12 months.
It's huge visibility.
It really is. And just to show the trajectory, that $2.94 billion backlog at the end of Q3 2025 was up from $1.86 billion just 1 year earlier in Q3 24. That's a 58.1% year-over-year increase in the backlog itself.
Driven by the acquisitions adding their backlogs plus winning new work.
Both, yes. Acquisitions bring their existing backlog, and then the combined entity keeps winning new contracts, fueled by that strong demand environment we discussed.
Now, that huge backlog sounds fantastic from a revenue perspective, but doesn't it also create a challenge, having to actually do all that work?
It absolutely presents a significant operational challenge. That's the flip side of a rapidly growing backlog. The company now has to effectively execute on this dramatically expanded workload. They need the crews, the equipment, the materials management, the project oversight.
Especially with those labor shortages you mentioned.
Exactly. Executing efficiently and profitably on a $3 billion backlog, especially while integrating major new businesses and dealing with industry-wide labor constraints. It's a great problem to have, absolutely. But it's a problem that requires incredibly disciplined management and operational excellence to navigate successfully. They have to deliver.
Okay, that brings us right to their financial performance then. Given this aggressive M&A strategy, the favorable macro environment, and now this huge backlog, how has it all translated into actual financial results? Have those growth levers truly delivered on the bottom line?
They really have, especially recently. The growth has been, frankly, explosive. And you can clearly see the impact of that acquisition strategy we just talked about.
Let's look at the top line first, revenue.
Okay. Fiscal year 2022, revenue was up almost 43% to $1.3 billion. Then FY23, it grew another 20% to $1.6 billion. And that fiscal 2024, fueled significantly by those acquisitions kicking in revenue, surged nearly 57% to hit $2.45 billion.
That's incredible acceleration.
It really is. And you see this strong upward trend across most of their key financial metrics. If you look at adjusted EBITDA, which is a key measure of operational profitability, sort of like earnings before interest, taxes, depreciation, and amortization.
A cash flow proxy, almost.
Kind of, yeah. It gives a good sense of the core business's earning power. Their adjusted EBITDA margin has improved steadily. It went from 10.4% back in FY22 up to 13.3% on a trailing 12-month basis as of the end of Q3 fiscal 25.
So not just growing bigger, but becoming more profitable per dollar of revenue.
That's the key takeaway, yes. Improving profitability. And of course, that project backlog we just discussed tells its own story, growing from about $1.36 billion at the end of FY22 to that record $2.94 billion by Q3 25.
Okay, that's the bigger picture trend. What about the most recent results? You mentioned Q3 FY25 seemed like a real breakout quarter.
It really was a standout. In that quarter alone, Q3 25, revenue surged 51% compared to the same quarter the previous year, hitting $779.3 million.
51% growth in one quarter.
Yep. And their adjusted EBITDA grew even faster, up 80% year over year, reaching $131.7 million for the quarter.
80%? How did they manage that?
Well, that leads to the most impressive part, record margin expansion. The adjusted EBITDA margin in Q3 hit 16.9%. That's a company record.
16.9%.
Right. And that was a 280 basis point improvement that's 2.8 percentage points higher than the margin in Q3 of the prior year.
What drove that big margin jump?
It seems to be a combination of things. Successfully integrating those higher margin acquisitions, like Lone Star, definitely played a big role, but they also showed significant operating leverage.
Meaning their overhead costs grew slower than revenue.
Exactly.
Oh.
Their general and administrative expenses as a percentage of revenue actually fell from 7.3% down to 6.6% year over year. So as they got bigger, their central costs didn't grow as fast, letting more revenue drop down to the EBITDA line.
Okay, so strong growth, record margins. But I recall you mentioning something interesting about that quarter's results versus expectations.
Ah, yes. Here's a fascinating detail for market watchers. Despite those stellar growth and margin numbers, the company actually missed the consensus analyst estimates for both revenue and earnings per share, or EPS, in Q3.
They missed, with 51% revenue growth.
They did. The miss was relatively small. I think EPS came in around 81 cents versus expectations of maybe 94 cents, partly due to those weather delays pushing some work out. But here's the kicker. The stock price actually increased significantly after they announced these missed results.
That seems completely backward. Why would the stock go up on a miss?
It tells you what the market was really focused on. Investors apparently prioritized the leading indicators. Things like that massive margin expansion and the huge growth in the project backlog over the lagging quarterly results that were somewhat impacted by temporary factors like the rain.
So the market looked past the short-term weather noise and focused on the underlying strength and future potential.
That seems to be exactly what happened. It's a really important lesson in market analysis. Sometimes the headline miss isn't the whole story. Forward-looking metrics and underlying trends can carry more weight. And importantly, management also maintained their full-year guidance for fiscal 2025, signaling confidence despite the quarterly miss. They still projected robust revenues between $2.77 and $2.83 billion and adjusted EBITDA between $410 and $430 million for the full year.
That's a powerful insight into market psychology there. Okay, now let's talk about the balance sheet. This aggressive growth, especially through big acquisitions like Lone Star, it doesn't come free, does it? How is all this being funded, and what does it mean for their debt levels?
You're absolutely right. Rapid M&A-fueled growth requires aggressive funding, and you see that very clearly on Road's balance sheet. Their total assets basically doubled, growing from $1.54 billion at the end of fiscal 2024 to $2.93 billion by the end of Q3 fiscal 25, just 9 months later.
Doubled the assets in 9 months. Wow.
Yeah, primarily driven by the acquisitions.
Yeah.
And a big chunk of that increase comes from goodwill.
Goodwill. Remind us what that is again.
Goodwill is essentially the premium a company pays when buying another business,
Right.
above and beyond the fair market value of its identifiable tangible assets like plants and equipment. It represents things like the acquired company's brand reputation, its customer relationships, its skilled workforce, those intangible things that have value. Road's goodwill surged from about $232 million up to nearly $776 million in those 9 months. That tells you a lot about the size and nature of the Texas and Tennessee acquisitions. They paid significant premiums for those established platforms.
And how did they pay for it? Cash, stock, debt.
Mostly debt. This growth has definitely been funded with substantial borrowing. Their total long-term debt increased dramatically from $487 million at the end of FY24 to $1.39 billion by Q3 25.
Whoa, that's a big jump in debt. Nearly $1 billion added.
Yes. Consequently, their financial leverage is an important metric everyone's watching closely. As of Q3 25, their total debt relative to their trailing 12 months of adjusted EBITDA stood at 3.17 times.
3.17x debt to EBITDA. Is that high,
Yeah.
low, average?
It's elevated. It's not necessarily alarming for a company in the midst of major transformational acquisitions, but it's definitely higher than where they likely want it to be long term. Management knows this, and they've communicated a very clear strategy to reduce this leverage.
What's the plan?
The target is to bring that ratio down to approximately 2.5x by late fiscal 2026. And the primary way they plan to do that is through generating strong operational cash flow from the now larger business. They intend to use that cash flow to pay down debt while still trying to preserve some capacity for future, probably smaller, bolt-on acquisitions.
So deleveraging is a key priority now.
It seems to be yes. Managing that debt load is crucial.
That level of debt definitely makes you think about cash flow. You mentioned this is a capital-intensive business. How much cash does it actually generate from operations? And how much of that has to go right back into the business's CapEx just to maintain things, let alone fund growth or pay down debt?
That's the right question. It is indeed a highly capital-intensive business. We talked about all those plants, quarries, heavy equipment that requires significant ongoing investment just to keep things running smoothly and up to date. That's capital expenditures, or CapEx.
How much were they spending?
For fiscal year 2025, they projected total CapEx to be somewhere in the range of $130 million to $140 million.
Okay, $130 to $140 million going out. How much is coming in from operations?
Their recent cash flow generation has been quite robust. In Q3 25 alone, cash provided by operating activities was $83 million. That was way up from $35 million in the same quarter the prior year.
That's a healthy jump.
It is. And for the full fiscal year 2025, the company projects it will convert a pretty healthy 80% to 85% of its adjusted EBITDA into operating cash flow.
Okay, so if EBITDA guidance is, say, $420 million midpoint, that means operating cash flow could be around $335 to $355 million.
Roughly, yeah,
Yeah.
in that ballpark. So if you compare that to the planned CapEx of $130 to $140 million, the CapEx represents something like 36% to 43% of their expected cash from operations.
So a significant chunk,
Yeah.
but they're generating substantial cash well beyond what's needed for CapEx, enough to make progress on debt reduction.
It certainly appears so. That remaining cash flow after CapEx, often called free cash flow, is what's available for things like debt repayment, acquisitions, or share buybacks. And it looks quite healthy based on their projections. It's also worth remembering that in capital-intensive businesses like this, cash from operations is typically much higher than reported net income, because net income includes large non-cash expenses like depreciation of all that equipment. Seeing strong operating cash flow relative to net income is usually a healthy sign here.
Okay, that makes sense. What about overall profitability metrics, like returns on investment?
Looking at returns, their return on equity, ROE, is currently around 10.6% on a trailing 12-month basis. And their return on invested capital, ROIC, which is arguably a better measure because it looks at returns on all the capital invested, debt, and equity, is about 7.0% TTM.
How does that ROIC compare historically?
Importantly, the ROIC has shown significant improvement. It was down around 3.3% back in FY22, but climbed to 8.6% by FY24. That trend suggests they're getting better at generating profits from the capital they deploy, likely reflecting contributions from both organic improvements and integrating those acquisitions effectively.
And what about direct returns to shareholders? Dividends, buybacks?
They don't currently pay a dividend. Like many high-growth companies, they prefer to retain their earnings to reinvest back into the business, primarily for those acquisitions and growth CapEx.
Makes sense given the strategy.
They did, however, authorize a $40 million share repurchase program, which runs through September 2025. They actually bought back about $5.3 million worth of their shares in Q2 of fiscal 24 under that program. So some capital is being returned via buybacks, but reinvestment remains the clear priority.
Okay, given all this, the aggressive growth, strong projections, improving margins, but also the debt and the M&A reliance, what does their valuation look like? Are investors paying a premium for this story?
Oh, absolutely. Road trades at what you definitely describe as a premium valuation. Its trailing 12-month price-to-earnings PE ratio, based on past earnings, is way up there, around 91.4x.
90 times earnings, that's high.
Very high. And its price-to-sales ratio is about 2.87x. Both of those metrics are significantly higher than the averages you typically see for the broader construction industry or the overall market.
So investors are clearly expecting a lot of future growth to justify that price.
Exactly. You see that reflected in the forward estimates, too. Analyst projections put the forward PE ratio, based on expected FY25 earnings, at around 58.7x. Still high, but lower than trailing. And for FY26, it's projected to fall further to about 41.5x.
So the market is anticipating very strong earnings growth over the next couple of years.
That's precisely what those numbers indicate. Substantial future earnings growth isn't just hoped for. It's already reflected or priced in to the stock's current valuation. Investors clearly have very high expectations for the company's ability to continue executing flawlessly on this ambitious growth strategy and deliver that significant earnings improvement. There's not a lot of room for error priced in.
High expectations, premium valuation. That leads us perfectly into the competitive landscape and the inherent risks. This industry, you said, is still highly fragmented despite some big players. Who exactly is Road competing against out there?
It's a mix, really. The industry is indeed fragmented, but there are different types of competitors. If you look at other publicly traded companies, probably the most direct peer is Knife River Corporation, ticker KNF.
Knife River, okay. How do they compare?
Knife River is also vertically integrated, also focused on aggregates and construction materials, but they have a broader, more mature footprint across 14 states, not just the Sunbelt. Their growth rates are typically more modest than Road's.
And the market values them differently.
Yes. Road, with its higher growth trajectory and that pure-play Sunbelt focus, generally commands a premium valuation compared to KNF. Even though KNF is arguably more diversified geographically, investors seem willing to pay more for Road's faster growth profile.
Any other public peers worth mentioning?
Sure. You have other civil construction firms like Sterling Infrastructure, STRL, and Granite Construction, GVA. They compete for large public infrastructure projects, sometimes against Road. And then you have the huge materials producers like Vulcan Materials, VMC, or Martin Marietta, MLM. They're more focused on selling aggregates and asphalt, though Vulcan also does some asphalt paving. They act as important bellwethers for the health of the overall construction materials market.
Okay, so that's the public landscape. What about regionally, on the ground?
On a regional and local level, it's a different picture. For the really big, complex transportation projects, Road might compete against large, diversified national or even international players. Think Kiewit, Fluor, Turner Construction, Skanska.
The giant.
The giants, exactly. But for a significant portion of their day-to-day work, especially the smaller paving jobs or site development project, and certainly for their acquisition targets, they're competing against smaller, often family-owned, private construction companies operating in those local markets.
The very companies they're looking to acquire sometimes.
Often, yes. That fragmented landscape of smaller private players is both their competition and their acquisition hunting ground.
That raises a really interesting question we touched on earlier. What are the real barriers to entry in this business? If there's so much demand, all this IIJA money flowing, why don't we just see tons of new construction companies popping up to grab a piece of the action?
It might seem easy from the outside, but the barriers are actually quite significant. First and foremost is the incredibly high capital investment required.
We're talking equipment.
Fleets of expensive heavy equipment, pavers, rollers, excavators, trucks. Then you need asphalt plants, aggregate processing facilities. These are multi-million-dollar investments just to get started at any kind of scale. It's not like starting a software company in your garage.
Definitely not. What else?
Second, and absolutely crucial, is access to raw materials. Owning strategically located aggregate quarries, sources of that essential stone, sand, and gravel, is a massive competitive advantage.
Why? Can't you just buy aggregates?
You can, but remember, they're heavy and expensive to transport. Having your own local source gives you a cost and supply advantage. More importantly, these are finite resources. And getting permits to open new quarries these days, it's a notoriously long, incredibly expensive, and environmentally complex process. Many communities fight them tooth and nail, so controlling existing permitted quarries is a huge barrier for potential new entrants.
Okay, capital and materials access. Anything else?
Yes. Third is expertise and reputation. Winning large government contracts, especially the complex ones, requires significant technical expertise, a proven track record of delivering quality work safely and on time, and the financial strength, the bonding capacity to back up multi-million or even billion-dollar projects. You don't just walk in off the street and win a major highway contract.
So experience and trust matter a lot. We talked about reputation before, but maybe we can revisit that. Do brands actually matter in this business, or is it just a commodity game where the lowest bid always wins?
It's a great question. While the physical products themselves, the asphalt, the aggregates are fundamentally commodities, brand and reputation are critically important, especially when dealing with their primary customers.
The state DOTs and government agencies.
Exactly. These agencies are stewards of public money, and they're awarding large, complex, multi-year contracts. They place immense value on a contractor's track record, quality of work, safety record, reliability in meeting deadlines and budgets. These factors weigh heavily in the bidding and selection process. It's not always just about the absolute lowest price.
So a good reputation can help you win work, even if you're not the cheapest.
It certainly can, or it can be the deciding factor between two close bids. A strong reputation for consistently delivering is a significant competitive advantage. And it ties back to Road's acquisition strategy, acquiring companies with strong local reputations and then preserving that brand and those relationships underscores just how much value they place on this. It's about building trust over decades, really.
Okay, so strong barriers to entry, reputation matters. Let's turn back to the risks. We've painted a picture of strong tailwinds and a clever strategy, but every high-growth story, especially one relying on acquisitions and operating in a cyclical industry, has inherent risks. Let's dig into the key risk factors investors or observers need to understand about construction partners.
Absolutely. This isn't a risk-free proposition by any means. Understanding these risks is crucial. We can probably group them into a few categories. First, let's talk operational and execution risks.
Okay.
Arguably, the most significant risk, given their strategy, is acquisition integration risk. Their growth is just overwhelmingly dependent on successfully identifying good targets, buying them at reasonable prices, and then this is the hard part, seamlessly integrating them into the larger organization.
What can go wrong with integration?
A lot. You could have culture clashes between the acquired company and Road. Key local managers who know the market and customers might leave. You could face operational disruptions as systems are merged. You might fail to achieve the cost savings or revenue synergies that were projected when the deal was made.
And if a big integration fails, like Lone Star?
If they were to stumble badly integrating a major platform like Lone Star, it can be very damaging. It would directly undermine the whole rationale for these expensive acquisitions and could significantly impact financial results and investor confidence. It's their biggest execution challenge, frankly.
Okay, integration is number one. What else operationally?
We've mentioned it before, but adverse weather conditions remain a constant operational risk. As we saw demonstrated in their Q3 '25 results, with the record rainfall causing delays, their operations are highly susceptible to weather disruptions. Prolonged periods of heavy rain, hurricanes, tropical storms, even unseasonable cold snaps that affect paving needs can all cause significant project delays, pushing revenue and earnings into later quarters or increasing costs.
Hard to control the weather.
Impossible. And then there's project bidding and cost estimation risk. A substantial portion of their work, especially on the public side, is done under fixed unit price contracts.
Meaning they bid a price per ton of asphalt or per linear foot of road.
Something like that, yeah. While this hedges them against uncertainty about the quantity of work, it means the company bears the full risk of accurately estimating its costs, labor, materials, equipment for the entire duration of that project, which could be months or even years.
And if they estimate wrong,
If they forecast too low, if labor costs spike unexpectedly, or material prices jump higher than they budgeted, it can significantly compress their profit margins on that job or even lead to outright losses. Accurate bidding is critical in this business.
okay, those are big operational risks. What about financial and market risks?
Financially, the most obvious one is their substantial indebtedness. We talked about that $1.39 billion in debt. That level exposes the company to risks associated with rising interest rates, which would directly increase their interest expense and eat into profits.
And it puts pressure on them to generate cash.
Absolutely. It requires disciplined, consistent cash flow generation to meet those deleveraging targets they've set. If they fail to delever as planned, perhaps due to weaker than expected earnings or higher capex, it could constrain their ability to make future acquisitions, thereby slowing down their primary growth engine. Lenders might become wary.
Makes sense. What else financially?
Inflation and input costs remain a persistent concern. While their vertical integration provides a buffer, they're still exposed to price volatility for critical inputs they might buy externally or whose price influences their internal costs, things like liquid asphalt cement, Diesel fuel for trucks and equipment, steel for bridges, concrete. Sustained high inflation can still squeeze margins, especially on those longer-term fixed-price contracts they signed maybe a year or two ago.
The vertical integration helps, but isn't foolproof.
Exactly. And finally, back to those labor market constraints. The persistent skilled labor shortages aren't just an operational headache. They're a financial risk, too.
Yeah.
They can lead to increased wage costs as companies compete for scarce workers. They can cause project delays, which have financial consequences. And they make it challenging to maintain a consistent, high-quality workforce, especially as the company is trying to rapidly expand into new markets and staff up those acquired businesses.
Okay, so operational, financial. What about regulatory or political risks, especially with so much work coming from government sources?
That's a major category, absolutely.
Yeah.
Their dependence on government funding is huge. Remember, almost two-thirds of their revenue comes from public projects.
Yeah.
So, Rhodes' financial health is directly, inextricably linked to the stability and level of government infrastructure spending. Any significant shifts in political priorities that de-emphasize infrastructure, or maybe a severe recession that hits tax revenues hard at the federal or state level, leading to budget cuts for transportation, that would have a direct and material adverse effect on their project pipeline, their backlog, and their future revenues. They are highly exposed to the political and fiscal health of the governments they serve.
A symbiotic relationship, but also a vulnerability?
Very much so. And then there's regulatory compliance. This is a highly regulated industry, subject to a whole raft of complex environmental health and safety, EHS laws and regulations.
Things like emissions, site safety, material handling.
All of that. Noncompliance can result in substantial fines, penalties, project shutdowns. And critically, serious or repeated violations could lead to suspension or even permanent debarment from bidding on government contracts.
Which would be devastating.
Catastrophic for their business model. So maintaining a strong compliance record and safety culture isn't just good practice. It's essential for survival and continued access to their primary customer base. It requires constant vigilance and investment.
Okay, so a complex web of risks to manage. Given all this, and the clear M&A-driven growth strategy, how are management's incentives structured? Are they really aligned with shareholders' long-term interests, especially considering the risks involved?
That's a key question for any company, especially one growing so aggressively. From the materials we looked at, management's motivations appear to be quite strongly aligned with the shareholders, primarily due to their significant personal stock ownership.
They own a lot of stock themselves.
Yes. For instance, the president and CEO, Jules Smith, owns roughly 1.14% of the company's shares. At recent prices, that's worth over $80 million. And the executive chairman, Ned Fleming, who's involved from the early stages, holds shares valued at nearly $250 million.
Wow, that's serious skin in the game.
It really is. When top executives have such a large personal financial stake tied to the company's long-term stock performance, it strongly suggests their interests are aligned with creating sustainable shareholder value, not just short-term gains.
What about their actual pay packages? How are they structured?
Their compensation policy also seems designed to reinforce this alignment. It's heavily weighted towards performance-based incentives and equity-based awards rather than just base salary. For example, the CEO's total annual compensation package is nearly 80% composed of non-base salary elements. Things like bonuses tied to financial targets and stock awards that vest over time.
So pay depends heavily on performance.
Largely, yes. It's worth noting that share-based compensation expense for the company was about $15 million in fiscal 2024. That represented about 22% of their net income that year, so it's a material component, but it's directly aimed at linking executive rewards to the company's financial performance and shareholder returns over the long run.
Any other governance points worth mentioning, like off-balance sheet stuff or accounting practices?
In terms of financial transparency, it's generally a positive sign that they appear to have minimal off-balance sheet liabilities. The main items mentioned are things like standard letters of credit for projects and some future purchase commitments, which are fairly typical. Nothing that screams hidden risks there.
And the accounting?
Well, as a publicly traded company, their accounting has to adhere strictly to GAAP, generally accepted accounting principles, and it's subject to independent audits by external accounting firms. Based on the filings and reports we reviewed, there were no apparent red flags suggesting overly aggressive or unusually conservative accounting practices. It looks pretty straightforward, which is what you want to see. #outro.
Okay, so let's try and bring all of this together for you, the listener. Construction Partners, Inc., Road, really sits at this fascinating intersection of some incredibly powerful long-term trends, doesn't it?
It really does. You've got this massive generational wave of infrastructure reinvestment happening, particularly driven by the IIJA. You have the undeniable demographic and economic boom happening in the Sunbelt region, where they are exclusively focused. And you have the ongoing consolidation of this traditionally fragmented construction industry, where they are playing a leading role as a strategic acquirer.
And management seems to have demonstrated a pretty clear track record, especially recently, of executing this aggressive M&A-driven strategy. They've used it to rapidly scale the company and build that strong competitive moat through their extensive vertical integration.
Exactly. They've skillfully harnessed what is arguably an incredibly favorable external environment and combined it with strong internal execution, particularly on the acquisition front. The results are showing up, that explosive revenue growth, the expanding profit margins hitting record levels recently, and that formidable project backlog, which provides a really high degree of confidence in near-term revenue generation. It acts like a clear runway for future work.
Right. However, and there's always a however, this impressive high growth profile clearly comes with significant risks. And maybe just as importantly, it comes with a premium valuation in the stock market right now.
That's the crucial balance. The company's heavy reliance on acquisitions, while successful so far, introduces substantial integration risk and execution risk that need constant vigilance. A misstep there could be costly. Their elevated debt levels, even though they have a clear plan to bring them down, demand careful monitoring and consistent cash flow generation.
And that concentration.
And their concentrated exposure geographically to the Sunbelt and customer-wise to government funding presents material challenges if those regional economic trends were to falter or if political winds shifted regarding infrastructure spending. And on top of all that, the market's already high expectations reflected in that premium valuation mean there's simply very little room for operational or strategic error. They need to keep delivering almost flawlessly.
So the core analytical question for anyone looking at this company, whether as an investor or just an observer of the economy, really boils down to this. Does the potential for continued high growth and further margin expansion adequately compensate for these inherent risks, the M&A reliance, the debt, the concentration, and for the high expectations that are already baked into its current valuation?
That's the nub of it. It's a classic trade-off analysis. High potential reward, but also significant identifiable risks. It really highlights the complexities of assessing these fast-growing companies, especially in capital-intensive sectors like construction.
Okay, so if you were tracking this company closely going forward, what key metrics or indicators would you be watching most carefully? What should listeners keep an eye on?
Good question. I'd probably focus on four main things. First, I'd watch the organic growth rates of its acquired platforms, especially after they've been integrated for a year or two. Are these businesses truly leveraging Road's scale to grow faster than they did before, or are they just maintaining? That tells you if the acquisition strategy is creating real value beyond just buying revenue.
Okay, organic growth post-acquisition. What's second?
Second, keep a close eye on the continued trajectory of those adjusted EBITDA margins. Is the operational efficiency still improving? Are they successfully realizing the cost synergies from acquisitions? Can they sustain or even improve on those recent record margins? That's key to profitability.
Margins. Got it. Third,
definitely track the pace of balance sheet deleveraging. Is their operating cash flow conversion staying strong? Are they actually paying down debt according to their plan, bringing that debt to EBITDA ratio down towards that 2.5x target? Or are new acquisitions or higher CapEx keeping leverage stubbornly high? That's crucial for financial health and future flexibility.
makes sense. And fourth,
I'd monitor the health of its project backlog. Is it staying robust or starting to flatten out? And just as importantly, keep an eye on the stability of state DOT funding in its key Sunbelt markets. Are those state budgets staying strong? Is the political commitment to infrastructure holding up? Because that's the ultimate source of a huge chunk of their business.
okay, organic growth, margins, deleveraging, and backlog state funding. Those seem like really solid indicators to track.
They should give you a good ongoing pulse of the business, yeah.
So as we've really dug into today, infrastructure is this fundamental, sometimes cyclical, but always essential business. What does this deep dive into one specific company, Construction Partners, tell us about maybe the hidden engines of economic growth in the regions where we live, and perhaps how seemingly boring businesses paving roads, crushing rocks, can actually be incredibly strategic and frankly quite exciting when you peel back the layers.
It's a great point. It really highlights how much complex strategy, operational excellence, and long-term investment goes into building and maintaining the physical world around us. These companies are capitalizing on huge trends, making big bets, managing significant risks. It's far from simple.
Yeah, it's a powerful reminder, isn't it, that the world around us is constantly being built, constantly being maintained, literally one asphalt layer, one bridge beam at a time by companies like Road. And they're shaping our daily lives, our economic landscape, in ways we often just take for granted or maybe don't even consider.
Well said.
Thank you for joining us on this deep dive.